This is an example from advanced accounting in creating a consolidation worksheet. So on January 21st, this is problem 25 from the book. On January 1st, 2015, Casey Corporation exchanged $3,300,000 in cash for 100% of the outstanding voting stock of Kennedy Corporation. Casey plans to maintain Kennedy as a wholly owned subsidiary with separate legal status and accounting information systems. At acquisition date, Casey prepared the following fair value allocation schedule. Immediately after closing the transaction, Casey and Kennedy prepared the following post-acquisition balance sheets from their separate financial records. Prepare a January 1st, 2015 consolidated balance sheet for Casey Corporation and its subsidiary, Kennedy. So information given from the book. The fair value of the consideration transferred, which was the cash, is $3,300,000. The carrying amount, which is the book value, is $2,600,000. So excess fair value is $700,000. $382,000 went to an undervalued building and an overvalued license agreement. So therefore, goodwill is $426,000. So they gave us post-closing, which means the transactions that happened up here are already, the cash was given out, is already taken into account into these accounts, right? So this is the post-closing balance sheet. They have cash, accounts receivable, inventory, investment in Kennedy, so this represents the purchase of the subsidiary. We have buildings, we have license agreements, we have goodwill. Then we have accounts payable, long-term debt, common stock, additional paid-in capital, and retained earnings for both companies. As you can see, they're in balance. So what we're going to do is create a consolidated worksheet. So I'm going to the second page. I've already set up these balances in my consolidated worksheet. All it is a copy of this. And what we're going to do is we're going to make journal entries to consolidate. These are called consolidation entries. So underneath here, I'm going to type this out, consolidation entry A. So entry A is where we're going to allocate fair value differences. So back into the problem, if you go to the problem, it says that the fair value differences, so I'm going to go back to the problem, were a building and a license agreement. One was overvalued, one was undervalued, and goodwill of 426. Okay, so first we're going to start with the building. And I'm going to link the spreadsheet in case we made a mistake. We can just take it right from here. Okay, so we allocate this. Then we have a license agreement. Normally, a fair value difference would add to it, but this isn't. It said that it was overvalued on the books, which means we're going to subtract from it, which means we're going to have a credit balance. And I'm going to change the sign because we don't have negative numbers in our journal entry. I did not like my scenario. I should put the negative sign beforehand. Okay, so we're crediting the license agreements for $108,000. Then we have goodwill from the problem. I'm going to take the goodwill over here. So, and then when we credit, it's going to be investment in Kennedy. We're going to eliminate the investment account with our two consolidations on date of acquisition. So, realistically, if you want to know how to make this, it's this plus this minus the credit, or $700,000. This number should also tie back to your excess fair value. That way you know if you made this consolidation entry correctly. Then we have consolidation entry S. Entry S is to eliminate the subsidiary's capital accounts. Okay, so the very first capital account we have is common stock. And we're just literally going to eliminate this capital account. But we're going to debit the common stock. Remember, we're not going to do negative numbers here. So debit the common stock. We're going to debit additional paid-in capital. and we're going to debit retained earnings, or RE. If they had more capital accounts, we would take care of more capital accounts. On the credit side of this, it's going to be investment in Kennedy. $2,600,000. Now, this should tie back to the number of the carrying amount or book value of the company. Remember, there's three ways to get to book value. One is net assets. The other is adding the assets, take assets minus liabilities. That's also called net assets. Or the third is to get to add up all the capital accounts. And that tells you the book value of the company as well. So now what we're going to do is we have consolidation worksheets. We have the book value of Kennedy, book value of Casey, and then we have a debit and a credit column. I want you to go ahead and link any debit that you made under the consolidation entries to the right account. So we had a debit to buildings. We had a debit to goodwill. We had a credit to license agreements. And we had a credit to Kennedy, investment in Kennedy. We're also going to link the common stock entry S. So we had a debit to common stock, a debit to additional paid-in capital, a debit to retained earnings, and we have a secondary credit to investment in Kennedy. So I'm going to add, you can also make a separate line. You can add and make a separate line. So when we get done, investment should have a zero balance on date of consolidation. So now we're going to put in a formula. It's book value of parent plus book value of the subsidiary plus the debit minus the credit for assets. And then I'm going to drag this all the way down. And I'm going to auto sum. I'm not going to drag the auto sum formula because I want to make sure in case I made a mistake, and also we didn't sum these columns. Now, because these are already in negative form, we're going to do book value plus the debit minus a credit. Same formula all the way down. If you didn't have these in quote unquote negative numbers here, you would change the signs on the bottom side. So we should get here, and this, when we see common stock on the bottom, it should only be the parent's common stock, the parent's additional paid-in capital, and the parent's retained earnings. So now I'm going to sum this up, and we should have a balance sheet that balances. If we didn't have a balance sheet that balances, we'd go back and check our consolidation entries or potentially our starting balances if we personally adjusted them. But now we have a consolidated total. So this is a consolidated worksheet for the balance sheet when we add Casey, the parent, and Kennedy, the subsidiary. And this is what we would report out on.